So a lot of the currency is something that people are a lot of frustrated with or, excited by it. First of all, when you look at it on a purchasing power parity basis, meaning like you look at inflation over time in Japan versus the other rest of the currencies, you'll see that it is dirt cheap, just absolutely insane. It's 109% undervalued according to purchasing power parity, according to the OECD, the way they do it versus the US dollar. I have a funny story. Last summer I went to Japan and I took my family, and I have three grown children. Like the youngest was just off to university this year, so and that he's my only boy. And we were there, and we went to Tokyo, and we were sitting in this restaurant. It wasn't super fancy, but it wasn't an Arby's. And we go into this one little room all alone, and we start ordering things, and we're pointing at stuff because it's in Japanese, and we're trying to, use our Google Translate. And my son finds the Wagyu beef, and he starts ordering all these Wagyu beef things, and I'm thinking, oh, geez, like he's going for it. And I'm kind of worried about the bill because you've heard these stories in the past about how expensive Japan has been. Bill comes, and it's like $1,900. And I'm like, oh God, geez, you know what? I shouldn't have let him order all that Wagyu beef and stuff. And then I do the math again, and I realize it's $190. It is dirt cheap, and the reason it's been dirt cheap is because their economy has been in the crapper for a long, long time. They haven't seemed to be able to do it. If you go to the next slide here, you'll see that this is my favorite way of measuring a currency. It's called the Big Mac Index. When you do that, you'll see, you go buy a Big Mac in Japan, you buy one, if you go buy one in Switzerland, it's, it costs you 31% more. You go buy it in Japan, it's 47% cheaper. So the reality is, from a purchasing power basis, Japan is dirt cheap. We go to the next slide, you'll see why. They've gone through no inflation for the past 20 years. It's been absolutely brutal. This is actual outright deflation at times. If you were to look at the US one, it's all green except for the occasional tiny, month or two of negatives. But on the whole, Japan has just had no inflation. And so we ask ourselves, what's changed? And we go to the next slide, you'll see that the actual government has changed. And this is some writing from Goldman Sachs. And the part that I really want to highlight is this part that it says Tokyo Stock Exchange's company governance reforms seem as a game changer. It's incentivizing listed companies to boost valuation and earnings, potentially delisting companies for not using capital efficiency. You actually, now if you're sitting on the Tokyo Stock Exchange and you're trading below book, you run the risk of actually being delisted. So this is a huge change in attitude versus where the Tokyo is, Japan has been in the past. And then we go to the next thing. You'll see that this change in attitude, it's working. We're actually seeing for the first time the Japanese topics. It's increased. It's up a long way, and people are kind of nervous about it. And they're saying, "Oh, geez, it's up all this way, and maybe I should sell it." And when you look at it on a price to book basis, it's still dirt cheap. And the other thing,
hey, Kevin, if I could just interject, just want to interject here because my readers are very programmed to understand the importance of big breakouts. And our thesis when it comes to breakouts is the longer the range has been in place, the more meaningful the breakout. And we're basically going back for 35 years here, making a 35-year new high. So it is incredibly significant in our way of looking at things. So that's one point. And also, maybe before you get off Japan, the idea of are they going to be winding down yield curve control to try to, because I think you believe that it's intervention by having the Bank of Japan buy the yen can only do so much. They've actually got to get real interest rates, or at least some kind of meaningful interest rates. But if that happens, what the ramifications might be of that?
Right. So, the Japanese government, they can go and tell everyone that they got to be more corporate friendly, but that's not really the reason you should be buying Japan. That's just a tailwind. The real reason you should be buying Japan is that they have extremely accommodative monetary policy and also fiscal policy, and they finally are going to break themselves out of this deflation that they've had for a long time. Now, that is why the yen is so cheap, and that is why their economy is doing so well. Now, eventually what happens is Japan at this yen rate, 155, they're stealing growth from the rest of the world. That is what is happening, because if you're an American car company and you're trying to compete against 155 yen, it's a lot different than when they were at 120 or 100. And so their economy is flying because of this. And ultimately, they are going to need to revalue it higher. This is almost like China did in the early 2000s when they kept their currency lower for longer because they were trying to steal export growth. And so when I think about this, I think about this economy doing really well. I think about the fact that the stock market, although it's run up, it's still really cheap. And not only that, the currency is dirt cheap. Dirt cheap. As I say, you can go there, you can buy, a dinner for nothing. It is the wrong price, that currency. And it's not like, if anyone's thinking about going on a vacation, I say go to Japan now, because it's not going to be here forever. And so, people have been buying the Japanese stock market, and they've saying to me, "Oh no, I got to hedge the currency." I think that's the wrong play now. I think the currency is going to be forced to revalue. I think there's a lot of people doing the so-called carry trade, and when these things come off, they come off in a whoosh. Like if you go back to, I can't remember when it was. I guess it was 1997. The yen went from 155 to 100 in a space of 2 months. And that is what I expect to happen here. And so I love the trade. I love long yen. I love long Japanese stocks, and I think you should short the interest rates, the JGBs, because I suspect that they are going to be forced to let the give up control of their YCC, and interest rates are going to normalize. So on the whole, I think that the Japanese stimulating cheap currency, even cheaper stock market. Buy them both. All right, next one is autos. This is gold priced in yen. We missed that, but we'll talk about gold in a bit later. So let's just go on to autos. I wrote a piece. It was called "Sell Your Autos." Seriously, just take them off your screen. I think this is at its best an absolutely terrible industry. It suffers from overcapacity even before EVs, and given all of the incentive that the governments have done over the last 5-10 years to try to get people to switch to EVs, we've gone from a situation where we are slightly overcapacity to hugely overcapacity in terms of production. Because at the end of the day, although EVs are different, a car is still a car is a car. And I think that there's 91 new EV only car companies in China. That's how many there are. And China itself has gone from becoming, an importer of cars to one of the largest exporters out there. Your clients and yourself, David, you're very familiar with Louis Gave's work. He's been talking about how China has gone out and they've almost created a whole new market of cars for the emerging markets in this $10,000 range. And when I look at this industry, I see an industry that is just has so much overcapacity that it's going to take years, maybe decades, to get rid of it. And I think it's just going to be a race to the bottom. It's kind of like Warren Buffett one time said that if he was a smart guy, he'd go back and he'd sabotage the Wright brothers when they were starting off to build their plane in Kitty Hawk, because he said people have lost so much money in the airlines. I suspect it'll be exactly the same way with autos. I think it'll be years and years of it going down. If you go to the next slide here, you'll see that the charts are already looking terrible. This is the MSCI World Automobile Index. Just, it's in a downtrend. It looks like it's about to, break through, support and head a lot lower. And when I'm thinking about, the next chart shows the Tesla versus the auto companies. Now, obviously, we all know the story there. Tesla is not just an auto company, it's a technology company, and Elon can do no wrong, and blah, 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 blah. The reality is that this thing is going to be valued like every other auto company within a year or two. So I think that when I'm playing this theme, Tesla is one of my main shorts. Although I think you could short them all, Tesla is my main short there. And I did the chart, didn't make the deck, but one of the things that I think you should compare this to is when you look at the pot stocks, the cannabis stocks. There was a ETF called HMMG, and everyone got very excited about this thing, and it was a bubble, and all of a sudden everyone had to own this because this was the legalization of marijuana. And what happened was, for the next 2-3 years, it just melted and melted and melted, and it was just continually dripping lower. And that's exactly what I expect that'll happen with the automakers. All right, next kind of theme out here is the end of disinflation. Ultimately, this is my theory about why I think we're going to have more inflation going forward. And it really comes down to monetary versus fiscal. And one of the things I would like to start off with is this chart of the Fed funds. And in 1982, we had a lot of inflation. And what happened was Volcker cranked rates and created the situation where he stopped inflation in its tracks. In doing so, he raised rates to 14% at the front end. And, the 10-year or the 20 and the 30-year were almost 20%. It was ugly. It was bad. It was a bad recession. But ever since then, we've done better. But one of the things that I just want to highlight is that in doing so, we made monetary stimulus the main way that we affect the economy. And if you look here, that first time in 1982, they took, 1982, he took it to 12. Then he lowered it to 9. Then the next time what happened was, as he lowered it to 9, the economy got going, and he raised rates. So he raised rates, and the economy slowed. And next thing he knows, the economy is slowing enough that he can lower rates. Now, as he lowers rates, people are taking more debt. In essence, what's happening is the private sector is responding to the changes in interest rates by expanding their balance sheet. And this is the private sector money creation. You go out and buy a house, you go buy a car, whatever like that. That is how the government is actually, or the Federal Reserve is affecting the economy. So in 1986 or whatever, he starts raising rates, and this time he doesn't need to raise rates to 12 or 14%. He actually only needs to raise it to 10. And the reason he only needs to raise it to 10 is because in the meantime, we've encouraged the private sector to take out more money. So they're all of a sudden more sensitive to rate hikes. Okay, so he raises it to 10, the economy rolls over, and then all of a sudden the economy is doing badly enough, they say we better lower it. Now they lower it, but they have to lower it to a new low. And the reason that they have to lower it to a new low is because, again, people have already got debt. So they have to make it to a new level of a lower level to encourage people to take out more debt. So all during this period, we have a situation where the private sector is being encouraged to take more and more debt each time. And so what that means is that the peaks that they have to raise rates to slow the economy aren't as high. And the levels upon which that they have to lower them to stimulate the economy are all that much lower. Finally, we hit a point in 2008, the great financial crisis. We lower it to 0, and we hit what's called a balance sheet recession. The government, no matter where they put rates to, nobody wants to borrow. The private sector says, I can't borrow anymore. The government tries a variety of different things, quantitative easing, Operation Twist, forward guidance, all these extraordinary kind of monetary means, but they really don't create the inflation that everyone expects or the economy that everyone expects. In the 2008, the post-2008 economic recovery was one of the lowest on records. Okay, so this happens. Finally, we get enough of a recovery. They can lower, or they raise rates. Again, they can only raise rates to 2% before the economy rolls over. Economy rolls over, then COVID hits. Now, this is the moment when everything changes. Now, I realized actually I should have been moving along the slides. Let's go to the next slide here. This is the U.S. household debt as a percent of GDP. And what you can see here is that in the 70s and 80s, it was very low. And as they lowered rates more and more and more, they kept encouraging the consumer to take more debt. Till finally we hit this point in 2008. It's at this peak. That's the point where they lower rates to 0. We can't do anything about it. People are just paying down debt no matter what happens. Next slide. David, you've put this one in here. Did you want to talk about this one?
Sure. I think this is one of the reasons why perhaps the Fed has had trouble slowing the economy and getting inflation down to their magic 2%, because so much of the private sector did term out their debt. So what that means in English is that, and just think about all the homeowners that refinanced their mortgages back in 2020, 21, 22, when the rates were very low. And so as rates got raised drastically, it's one of the most aggressive Fed tightening campaigns ever. It really didn't have as much of an impact. And the other thing that I would point out, it's not shown here visually, but if you look at U.S. non-financial corporate net interest payments, there we go. They're at the lowest they've been since 1956.
Right.
So, but then, and as Kevin's going to talk about, you've got the federal situation, the fiscal stimulus, which is, of course, another reason why the Fed hasn't been very successful in cooling things down, because while they've been trying to hit the brakes, and actually in many ways hitting the brakes hard, the federal government's been slamming the fiscal accelerator to the floorboards. And actually, Kevin, I want to give you credit because I listened to a podcast from you months ago, and I thought, this is really the way it's going. These things like the inverted yield curve and the falling leading economic indicators, they're not working this time. What's different? And I think what's different, of course, is that fiscal stimulus that you articulated on many occasions. So enough said on that one.
So the next slide, you can see what David was talking about, the fact that the corporate America did the same as the individuals, and they termed out their debt. And I just the next slide here is the point that I think that the world changed. And that little guy there is COVID. And the reason that the world changed at that point was that instead of us trying to fix everything with monetary, we finally accepted that fiscal was more powerful and went with fiscal stimulus. And it really did change everything. And I don't think, even to this day, I think market participants are still underappreciating the power of fiscal. And we see this situation where everyone's expecting the economy to roll over, and it just refuses to roll over. And I think that the part of the reason it's not rolling over is because the fiscal stimulus is way more powerful than we think. Now, if we go to the next slide, you'll see here that the government is actually running a deficit of more than 5%. And go look through here, you'll see that usually when they're running more than 5%, we're in a recession, or we're just coming out of a recession. We haven't been in a recession for 4 years, and yet we're still running a deficit of 5%. And what's really amazing about this is that we're running a deficit of 5% while unemployment is 3.5%. If we go to the next slide, we can see here, I plotted the percent of deficits of GDP versus the unemployment rate. And you'll see that the blue lines are the pre-COVID periods. So as the unemployment rate goes up, you generally had a situation where the deficits went up, mostly because of automatic stabilizers and the government going and trying to stimulate a little bit of the economy out of it. But look at those orange dots. Those orange dots represent the post-COVID period. And this is just unprecedented in terms of the amount of fiscal stimulus that is occurring in the markets and in the economy while we're having this sort of unemployment. So if we go to the next slide, you'll see that the PCE, this is the Fed's preferred method of inflation, of watching inflation. The line there represents their target. And you'll see on the whole, for the past 20 years before COVID, they were hitting it almost, pretty close. They were, they were under in the post GFC. They were slightly over in the pre GFC, but they were around 2%. But now all of a sudden we had, 5-6%. And, this is different than CPI because it's the core. My point about this is that period where all of a sudden it blew out and went higher, everyone's expecting it to go back to the pre-COVID period. And I think that's a mistake. And the reason I think it's a mistake is because even though our economy is doing well, we keep doing fiscal stimulus. We have a situation where both presidential candidates are just kind of competing in terms of how much they want to spend. One of the candidates for the Republicans, the presidential, like the one that was competing, Nikki Haley, she went out there and tried to talk about being, austere and figuring out how to balance budgets, and that got her nowhere. So, why is that? I think it has to do with the fact that we've kind of realized that we've unleashed this genie out of the bottle, and politicians realize they can spend and they can realize that they can buy votes. And whether you like it or not doesn't really matter. You can sit around and you can complain. You can say how this terrible it is. You can get all morally indignant about it, or you can just figure out what's happening and then change your portfolio based upon that. And so to me, I think that this has been like as I say, the toothpaste is out of the bottle. We're not going back to governments that are going to try to balance their budgets. And because of that, I think that we're going to continually overshoot on the inflation basis, and we're going to be a lot higher. If you told me tomorrow that Nikki Haley was going to get back in power and was going to go out and was going to balance the budget and tax more and spend less, then I would be the first guy to say you should go out and buy bonds. You should sell the stock market and you should buy bonds, because the reality is the economy is about to, sell off or slow down significantly. But I don't think that's going to happen. I think that we're going to have more and more spending, and there is absolutely no signs that this is going to change. And if so, we're going through a period where we're going to have inflation that surprises to the upside. The next slide here, David, you put this in. Did you want to chat about this?
Yeah, it's from my buddy Vincent Delouard, and it's very consistent with what you've been saying. And it is really pretty amazing that so I'm old enough. I don't know if you even heard this term, Kevin, because I started this in 1979. So just as Paul Volcker was becoming the head of the Fed, that was a little bit more important than me joining the financial industry, by the way. But I can remember when bonds were called certificates of confiscation.
That's right.
And frankly, like you, that's what I believe they are today. And for 40 years, up until the summer of 2020, I was mostly a bond bull. There were some times late in a cycle where I'd get more defensive and shorten duration. But for the most part, I was a buyer of bonds, particularly anytime they sold, like your chart that showed those periodic spikes in yield. But today, what's out of favor with the retail U.S. investors, it's gold. Ironically, whereas they're still pouring huge amounts of money into not just treasury ETFs, but long treasury ETFs. And they did that last year just in time for another spanking this year. And long treasuries have lost something like half their value on an inflation adjusted basis since 2020. It's been just a bloodbath, and yet the money keeps coming in. And it's pretty amazing. I know that you're not so much a fan of TIPS, which is the second line there. So those are treasury inflation protected securities, but because they are still bonds, and that creates a risk on the bond side. But there are these inflation break-evens, which is a pure play on inflation rising. And it's illogical, frankly, but that's the way people are behaving right now. And I think it creates a heck of an opportunity. So even though gold is corrected and the gold miners are corrected, I think that's temporary, that we're in a long-term uptrend, and feel free to disagree.
No, I completely agree. And to your point about the bond market, how badly it's done, if we go to the next slide, you'll see here that this is the real returns of the Bloomberg U.S. Aggregate Bond Index. And I'll tell you a funny story. I wrote a piece for Bloomberg, an opinion piece, and I think it was after the first year that was down, and it was at the end of 2021. And I suggested that we might have 2 years in a row, not just like not a bad year, but just 2 years in a row of the bond market going down. And David, you should have seen the comments I got. It was brutal. Basically, people like it's kind of scary when you get these people that are running money, very, accomplished fixed income portfolio managers that are running billions of dollars, emailing you, telling you what an idiot you are, because the bond market has never had 2 years in a row that it was down. And to suggest otherwise, you're going to learn your lesson. You're going to see that the bond market is going to do great. Then it proceeded to have the worst year on record there. So it's kind of it's shocking to me how much people continue to buy into this narrative of this idea that you have to own bonds. And I'll tell you why I think this occurs. In 1982, when Volcker broke the back of inflation, there was all sorts of folks that said that inflation is going to, spike back up. It's going to be terrible. There's no way, if this isn't the tie in inflation. And in fact, one of the most renowned economists at the time was a guy named Dr. Kaufman. It was Dr. Doom was his name, the original Dr. Doom. And he worked for Salomon Brothers, and he predicted that we would have 25% inflation, all this stuff. And so even though inflation in 1982 and 1983 declined eventually to 3%, bonds at the long end stayed really high in terms of yield. So they offered a high real yield, meaning that you could lock in a high real yield, because the reality is very few people thought that inflation was truly going to be headed lower. I think that we're in the absolute opposite situation right now. Everyone expects inflation to return to the pre-COVID, post-GFC era of sub 2%. And so therefore they're all buying the bond market. They're buying the long end. That's part of the reason that we're inverted in terms of the yield curve. It's part of the reason that the term premium is so little. And it's just going to be one of these situations where it's just going to take time for them to realize that this is headed inflation is stickier than they think, and the rates are going to be higher. And in the meantime, it's going to be a great short, just like the bonds were a great buy in the early 1980s. Bonds will be great short for many years. All right, if we go to the next thing, the slide, although I am telling you why I hate bonds, this slide is actually a little bit of why I'm also worried about the stock market. And this is called the equity risk premium. And basically what it is the difference between the earnings yield that you'll get, meaning what does the S&P or what does the stock market earn, versus the what does the bond market give you. So a risk-free rate versus a risky rate. If we go to the next slide here, you'll see that in March 23 of 2020, this was the low in the S&P 500, the point of maximum fear when it came to the COVID crisis. You'll see that the US 10-year Treasury yielded 0.75. Now, first of all, that in itself is just an amazing statement. The fact that you were giving money to the government at 0.75 when they told you that their inflation target is 2%, and you were like almost paying them, to keep your money, is just absolutely insane. It showed you how convinced everyone was that rates and inflation wasn't a problem and the rates were going to stay down there for so long. The S&P 500 was trading at 2,400. The forward earnings estimate was $160 per share. So that means the earnings yield was 6.67. So the S&P was earning that much, like it's almost 7%. And meanwhile, bonds were yielding 0.75. So that was an equity risk premium of almost 6%. Now let's go to today or last week. You'll see that the next slide here, that the U.S. Treasury is yielding about 465. The S&P is trading at 5,050. The forward estimate is $252. So the earnings yield is 5%. That means that the equity risk premium is 0.37. If we go back to the two slides before, you can see that model. You'll see that the lower this is, the higher price stocks are versus bonds. And we are now at a point where this is as low as it's been since 2001. This is a really scary thing. And I saw a headline in the Wall Street Journal the other day where you said something to the effect that pensions are moving billions of dollars out of equities into bonds. Go forward 2 slides, and then we go one more slide to this new one. And what this is a chart that shows the equity risk premium and then the forward return of stocks over bonds. So if I'm right about the equity risk premium, I should see a relationship here. And unfortunately, we don't see any. This is just almost like a scatter plot. It doesn't mean there's no predictive value of this. So you think, well, why are you talking about the equity risk premium in that case? Let's go to the next slide. That was 1-year returns of stocks versus bonds. This is the same thing for 10-year returns. So what the lesson there is, it shows you that although for the short run, stocks and bonds and the equity risk premium can vary and it's not very predictive, over the long run, the lower you buy an equity risk premium, the lower your returns will be in equities. So we're almost at zero now. So you shouldn't expect equities to do very well. All right, let's go to the next thing, which is gold. I know our buddy Louis Gav, he talks about the anti-fragile asset. Gold, is it the new anti-fragile asset? The next slide here is why I think most people have missed this trade. Gold is traditionally being correlated to US dollar and interest rates. Specifically, real rates work better. So what I've done here is I've created a chart, and the blue line is gold. The white line is the inverse TIPS yield. All right, so that's the real yield. So because it's inverse, that means as the TIPS go down in yield, the line goes up. So you'll see in 2020 when bonds were bid and the rate was really low, gold followed it higher. But then in 2021, actually 2022, this relationship went like this. And something happened there to change that relationship. Next slide. It was this dude. He went and took over or invaded Ukraine. And in doing so, the Western world said to him, you know what? We don't like that. You're not playing by the rules, and we're going to take all of your FX reserves, your international reserves, and we're going to take them. And in doing so, the West changed the rules about how money is treated. This has never been done before. And I just contend that if I'm the People's Bank of China and I'm thinking about my reserves that I own, and I get into a situation where all of a sudden I realize if I do something that the Americans or the West doesn't like, they might take away all my money. It changes the risk reward. And so I've been saying this for the past couple of years. I've been very steadfast in this argument that everyone is focused on traditional valuation metrics for gold, and they're missing that the world has changed. And if we go to the next slide, we can see how the world's changed. All of a sudden, central banks are buying record amounts of gold. And it's really that simple. I think people are overthinking it. I think that they don't put themselves into the People's Bank of China's kind of mindset. Like, just think about it. If you were to all of a sudden be put into that, FX reserve position, and you were the one that was in charge of that, I know what I would do. I would get on the bid of gold every single day. I would just be like, I'm going to VWAP buy a certain amount because they are so large. They have so many reserves that they can't buy enough gold. I'll be the first to say it. They probably can't buy enough gold to even make a difference. But to me, they have to try. And I think that is the part that everybody's missing, is that that they're focused on the geopolitics, or they're focused on the retail buying it. Those things don't matter. And in fact, all that happened recently was that we had this consistent bid from the central banks, and all of a sudden, instead of those other things being a negative, they were a positive, and it just created a quick little whoosh higher. So if we go to the next slide here, you'll see that this is one of my favorite cartoons. Everyone loves this. It shows, China throwing over the dollars and we throwing over the gold bricks. And you can see this in particular. If we go to the next slide, you'll see this in real time happening. This orange line is the gold, the GLD ETF, the amount of gold that we owned, and it's going downward. And the reason is because we in the West are selling gold. And the blue line is this ETF in Japan. Remember what we said about Japan. Japan's keeping their interest rates too low. Their dollar's going down. The retail is saying, you know what? I'm going to buy some gold. And so it's not just the People's Bank of China. It is other Asian Asian individuals buying gold. But on the whole, I just want to show you how there's one's going down, the other's going up. And if we go to the next slide, you'll actually see that this is that same ETF. You'll see that it actually blew out and went to a premium versus NAV, meaning that people were paying higher than the NAV to own gold. We can't get enough gold out in Asia. Off the record, I was actually talking to a buddy that works actually in the bond market, but he's in one of these big sell-side banks, and he was saying that their bullion desk, they're just getting swamped with sell orders, and that they're taking delivery of gold, and they have to increase the amount of insurance they're holding because they keep getting sell orders. We keep selling it. We as Westerners, because we're going back to that first chart, We're convinced that rates are going to matter, USD is going to matter, and we're focused on that things, the traditional old way of valuing gold, and we're not realizing that something fundamental has changed and that those aren't what's driving gold anymore. If we go to the next line here, you'll see that this is the blue line is the percentage return in gold, and the white line is the percentage return in the GDX mining index. And until, February, the actual GDX was down 25% and gold was still up 5%. And you might say, well, why is that? Two reasons. One is these stupid miners, they can't increase their margins even though gold is going up in price. So gold's going up in price, but unfortunately their costs are going up just as high, just as quickly. So we're having this trouble where they're really not making any more money, even though we're getting higher prices. But the other reason that this is occurring is that up until, February, when we started to get a little geopolitical angst and all of a sudden retail woke up to gold, on the whole, who did I say was buying gold? Central banks. Central banks are driving this. And the People's Bank of China, they don't want the miners. They have no interest in the miners. They have interest in the actual underlying commodity. So that's not surprising to me that gold miners have underperformed. Now, I think that's about to change. I'm very bullish on gold miners going forward. And I think that what's going to occur is that all of a sudden, even they will not be able to have their costs increase enough to not have expanding margins at this point, meaning that they won't even have a time to go out and buy enough Lear jets or whatever it is to spend this money. So their margins are going to increase. And what you're going to find is all of a sudden they're making more money, and it's a self-fulfilling kind of feedback loop. If we go to the next slide, you'll see that this is the gold and gold miners as a percent of global assets. It is tiny, just absolutely tiny. So I don't think that people appreciate as well how little it's going to take to move this industry. It'll go like that. And to the next point here, this next slide, you'll see here, David came up with this thing he calls the Don Ho market. And he says the Don Ho tiny bubbles. And he says to me, you think that's too cheesy? I go, you obviously don't know me well enough. That's perfect. That's very on brand. And the reason I talk about this is if you go to the next slide, I've been chatting about this thing about a series of mini rolling bubbles for a while. I think I started talking about it in 16 or 17. I started to notice that the world had changed and we were getting more and more of these kind of spikes higher for a year. And then all of a sudden it came back down. And this chart kind of tries to show how we're getting more of these. And I fully expect that, next slide here. I'll show you the one that I like best. This is ARC. Like we forget, and I figured out, I did some math to figure out how much money we've lost, like investors have lost collectively in the ARC indexes. They've lost $15 billion. But think back to 2021. That like screen clip that I've included there, everyone was tuned in to listen to these four mavens talk about their genius. And this was a perfect example of these little mini rolling bubbles. It went straight up and then right back down kind of a year later. And so if you go to the next slide, I've put together a couple of examples of kind of these little mini bubbles. This is a perfect example of the Goldman. This is an index of the Goldman Sachs AI winners versus losers basket. You'll see that you have this initial bit of outperformance. Like I still remember that period at the beginning of 2023. Geniuses like my idol, Stanley Druckenmiller, started talking about how this was a great business. And I thought to myself, it's already run too far. Well, look what happened. We had the initial bit of outperformance, a little bit of follow through, and then it just became bubblicious. This is an example of the bubble. Another one, next one, uranium. Even though I don't think this is the bubble, you can still see the pattern. You get this initial bit of outperformance, then some follow through buying, and then it keeps going. So I think that right now on the gold miners, we're at that little bit of outperformance. And I suspect what's going to happen is in the coming months, we're going to get them finally, being good on the earnings. So we're going to get momentum on the earnings. We're going to get momentum on the stocks. And the fact is, it's a very small market. It's going to feed upon itself. And I've learned the hard way about these bubbles, about thinking something has gone too far, too fast. I've said it too many times. I said it with AI and I got short too early. I said it with the stupid EVs, the electric vehicles, because that bubble looks just the same. I was way too early. So I've learned my lesson. I don't think that you should ever say too far, too fast anymore. You should wait because the bubbles have a way of being quicker, more violent, going farther than you ever imagined. And I suspect that the gold miners, and I suspect and I hope that the gold miners are the next ones to go. All right. Questions?
Yeah, but I'll start out here. I made some notes while you were talking on some great points. And one thing you were mentioning is how the central banks are relentless buyers of gold, at least the foreign central banks. And one of the ones that's interesting in that regard is China, which has obviously been a very aggressive buyer. But correct me if I'm wrong, I believe that despite all the buying they've done, their reserves are still very low.
They're still very low as a percentage of their actual reserves. And that goes to show you how much they have to buy.
Exactly.
It's just so, and that's kind of my point. And one of the things that I worry about with gold, when I worry about the People's Bank of China buying, it almost seems like it's such a small amount and they have to buy so much that they might not even bother. But I just don't think from a risk reward point of view that makes any sense. Even though it's small, even though it really, they can't move the needle in the big picture, I think they still have to do it.
I agree. And before we open this up for other questions, I just want to mention that Kevin's newsletter is available. He's offered very generously to send out samples to anybody that's interested. So Kevin, maybe just tell them real quickly how the best way they can reach you.
Sure. If you guys want a sample, feel free to give me an email at kevin@themacrotourist.com and I'll hook you guys up.
Thank you. That's great. All right. I know we got questions out there.
Rajiv, go ahead.
First of all, thank you so much for a great presentation. I also saw your presentation on thoughtful money. I thought you did a great job. And also, David, thank you for your continued excellent work. My question is a pretty simple one. Since you've kind of mentioned uranium, I was kind of wondering if you think it still has more room to run.
Yeah, so I do believe that uranium's headed a lot higher. I think that one of the things about the EVs that and this AI, I'm going to include two bubbles. If you think about what we've done, we've gone and said to the world, let's go and let's change our vehicles from fossil fuel to electric. And even before the AI needs the power needs from AI, that was already going to be a challenging thing to do. In terms of, we were very aggressive in terms of trying to change that electrification in terms of the time frame. And so I was already thinking that the uranium was going to be needed and that we were going to have more nuclear power plants. And then you throw in AI. And the thing about AI is that we're finding out it's absolutely just a huge energy suck. So I think that between these two things, that electricity is headed to the moon, and along the way, uranium is going to be dragged along with it. It's a story that's going to last. It's got a lot more legs.
So Kevin, one of the challenges that I've had is that it's not like energy. You've got lots of cheap oil and gas companies, lots of cheap gold mining. If you go to that, back to your thesis on gold, which I totally agree with, but it's tricky to find equity plays in the uranium space because there's so few of them that make any money. And some of the most exciting ones are still years away from production and profits. So how have you squared that circle? If you have?
I think that people overthink it. I know after sitting on an institutional desk that if you're Fidelity or Cap Research, you can't buy, Next NEXE or anything like that, or the SPUT, they call it the U.UN. You can only buy the biggest one. So to me, if you want to play this safe, you buy Cameco. I know all the stories, all the negative ideas out there. I think that they're, on the whole, those are just inside baseball, and it's that ultimately Cameco's got a huge asset. They're going to do fine. That's the only one you can buy. In the old days, you could buy the Kazatomprom one, but you can't do that anymore. That's not going to work. So really, for big institutional accounts, there's only one thing to own, which is Cameco. So they're going to own it. So I suspect Cameco will trade at a big premium, and that's what I would just stick with.
Thanks. I think you're right.
Yeah.
Let's try to buy it on dips,
Murat.
which there's been a little bit of lately.
Murat, go ahead.
Oh, sorry. Just to follow up, Kevin, to your statement regarding how to play Cameco for a retail investor, would you still recommend staying with the big player Cameco, or would it be prudent or wise to invest in a uranium miner ETF, with the obvious one being URA?
Yeah. So on the whole, I have no problems with those sorts of ETFs, and I am not a individual stock specialist, so I really can't speak to this very well. I will say this though. I think the U.UN, meaning the SPUT, the closed-end fund that owns actual uranium, that to me is something that should have a larger portion of your uranium portfolio than most. So I just said that Fidelity can't buy it, but for me, that's what I would own. I would probably, if I was to chew it, I would do a third Cameco, a third SPUT or U.UN, and a third some sort of uranium ETF, just so I get a little exposure to the juniors.
And as many of you know,
much.
the way we play that is SRUUF. That's the American version of the ETF that holds the Sprott Uranium ETF, which fortunately has been very good to us. Who else do we have?
Ken W., go ahead.
Thanks very much for the presentation. Quick question: when you talked about everybody termed out the debt, but there seems like the mark-to-market value of a lot of that debt, you just drive around, you see commercial real estate vacant everywhere. And if your thesis is right around autos, that means banks are holding loans against assets depreciating at a higher rate than they normally do. How do you see the kind of losses, the unrealized losses currently in the lending portfolios playing out across the different markets?
Well, this was one of my big mistakes last year, and one of my big mistakes was I was kind of an economic bull, rightfully so. The economy did better than I expected, and generally, when the economy does well, you get a situation where regional banks should do well. And having said that, I was such a bond bear. I could never imagine that anyone would actually go out and buy duration in bonds, like when it was 1%, 2%, 3%. And I assumed that most people would be like Jamie Dimon. And Jamie Dimon, if you listen to him all along the way, he was talking about this could go higher. We could be careful here. There's all sorts of risks on terms of the bond market. And although everyone says you borrow short, lend long, that's kind of an old-fashioned view about banks. Or at least I thought it was. And it definitely is an old-fashioned view about sophisticated banks like Jamie Dimon's JP Morgan, but it ended up being not a very, it wasn't the correct view when it came to regional banks. And they ultimately did make an absolute mess. And the irony about it is that the government didn't want them going out and lending too much on real estate. And so they ended up blowing up by owning just simple government debt, which is just asinine and crazy, like that to manage to mess it up. But I think that there's more to your question than just that duration part about it. You're also worried about the credit portion of it. It is difficult to square all these pieces because we do have a lot of moving parts, and there's no doubt, like if you take commercial real estate, especially the office one, we still have some pain to come in terms of refinancing these things. And ultimately, I think that this is part of the reason that the Federal Reserve is a little more dovish than a lot of people want them to be. If you listen to a lot of Wall Street, they talk about how, oh, you promised us that you weren't going to be Arthur Burns. And yet, although he hasn't actually lowered rates, let's face it, they pivoted really quickly and actually guided towards cuts at a surprisingly a quick pace. And I think that the part of the reason is that he sees those worries that you're talking about. He sees these things coming due. He sees the maturity wall coming. And ultimately, the way I think this plays out is that the Federal Reserve will be easier than the market expects. and they will, in essence, normalize the yield curve, meaning that they'll have it lower so that banks can borrow at a better rate, and they will try to earn their way out of it. Like if you go back to the Brady bonds, when governments went and lent to all these Latin American countries, the way that the Federal Reserve and they fixed it was they just had the front end way lower and they just kind of continually rolled it over. So ultimately, the way I think this plays out is with a Federal Reserve that ends up being looser than everyone expects. And again, that just to me creates more inflation.
Thanks.
Neil Windward, go ahead.
Hey, Kevin, thanks for the presentation. I sat in on a webinar hosted by Louis Gard the other day on gold, and
Yep.
Philippe Lesson said, you know, he feels like there's a whale out there buying. And then Luke Groman in his hearings on Friday said maybe it's Janet Yellen through proxies. You know, and I wondered if you had any thoughts on that. I know it calls for speculation, but you might.
So wait, Luke is suggesting that Janet Yellen is buying gold?
He's suggesting that she's buying gold. I mean, he had been going down the track of saying, you know, she has room under the exchange stabilization fund
Yeah.
to you know, to sort of make some moves. And it was just sort of interesting that it came on the back of Philippe saying, you know, it feels like there's a whale out there. And that Luke came in and said maybe it's Janet buying through proxies. I don't know.
So I'm like the worst when it comes to being exciting and coming up with these theories, because I found over the years that a lot of these sorts of speculations and stuff are interesting. They make great talk. You go and you say the world's going to end, China is going to have to depeg, it's going to go to 10, or you go and you say that something dramatic, and the amount of times that actually occurs is very, very low, and the amount of times that these theories that you hear on FinTwit end up being correct is almost zero. So I think it's just do I think that the Janet Yellen is buying gold? No. Almost like I don't know how to put an odds on it. I'd put maybe 1 in 100, maybe even 1 in 1,000. It's just not something in their MO that they're not going to bother. They have no real need to do it. And even like Luke's theory about this idea of gold for oil, and it's going to be this dramatic, you know, rethinking about the whole environment and stuff. I don't think that these central bankers and government officials are as smart as to do those sorts of, you know, grandiose change the world type things. I think that a lot of times they're just going from thing to thing and just putting band-aids on it. And so I suspect that the reason gold has done well is because, you know, Russia went and invaded Ukraine, and all of a sudden, you know, China looked at this and said, hey, wait, they just zeroed all their FX reserves. We better buy some gold. And I think that they're the whale that's out there just bidding for it. And that's what it's just the simple answer is usually the right answer. And to me, that's what's happening there. The other thing is, I think yeah. The other thing I will say is that if you go look at the action before, like take the pre-geopolitical action of like 2 weeks ago, like last 2 weeks, we've had a lot of geopolitics that have affected gold, and it's definitely changed the nature of the trading. But look at it, those pre that time, often what you'd find is gold would be up $20, $30 overnight, and then it would be selling off during the day. And I had really smart guys going, what the hell? Why doesn't the central bank in China or the Asian buy in America? And I said, well, it's not that easy because they actually want the physical stuff. So they just don't bother. They buy it in their time zone. They take delivery of it. And then what happens is it comes trading in our time zone and it gets sold. So I think that behavior of the market action is indicative of the fact that it's not the U.S. Treasury buying it. It's in fact the Asian central banks.
All right, thank you.
And I would just say in general, I mean, you think about the Chinese, and there's a lot of them, and a lot of them have wealth, and they've been clobbered in real estate, they've been clobbered in the stock markets, so gold looks pretty good. You look at Japan, they can't get any return on their cash, And their stock market, even though it's been going up, they tend to be very underweight stocks. I think 13% is the total average household commitment to equities in Japan. And then India, which has got, now the most populous, the largest population in the world, and they're very pro-gold. So I think that the main point that Kevin's making, and one that Louis certainly agrees with, and I do as well, is that we got this big gold migration going on from west to east, very similar to that funny cartoon that Kevin ran. And so I think that's the ultimate driver. It would be really interesting that American investors tend to hop on these things kind of late in the game. I think once the U.S. retail starts to go nuts on gold and the memers get involved, which they kind of did in 2020, then that may be the end of that particular bubble. Dad, do we have anybody else in the queue?
We don't have anyone else in the queue. We do have a question in the chat related to gold. It says, we saw Zimbabwe institute a gold standard approach to its currency. Many reasons why, but could this be the canary in the coal mine as an interesting approach to impact the West and its monetary advantages, with potentially China and other countries doing similar or hybrid gold standard?
Yeah. So again, I'm not your guy when it comes to these sorts of theories. I don't think that's what's happening. I don't give central banks, governments that much credit. I think that they're literally just going and putting band-aids on things bit by bit, and that's all that's happening, and it's as simple as that.
Something I wanted to bring up, Kevin, that's sort of related to this is your very interesting theory, which I had a hard time believing initially until I thought it through more closely, because it sounded a lot like what was a guy that Erdogan in Turkey, which basically that higher interest rates are stimulative to the economy. And that was very counterintuitive and very different than what I've seen through my 45-year career. But as I thought more about it, it does make a lot of sense, though I think that it's bifurcated. And I wonder if we do have, a real Dickens of a problem, and not a tale of two cities, but a tale of two consumers, tale of two corporate sectors. So if you get these dramatically higher interest rates, for a lot of people, it's great. Well, not the majority, but for the wealthy investor and for the cash-rich corporations, it's actually a transfer of wealth from the federal government and taxpayers to them. Right. And yet for companies that are highly indebted, which unfortunately tends to be a lot of the small businesses, and they've got floating rate loans. So for them, it's very painful. You've seen the stats on credit cards, and what's the average interest rate on the credit card balance is now 22.75%. And there's over $1 trillion in credit card debt. Credit card delinquencies are going ballistic there. If it was a stock chart, I'd buy it. Same thing with auto loan delinquencies. So we're seeing some real stress, and yet at the same time, we're also seeing this windfall effect. And so it's it's like push me, pull you. It's going in different directions, and it's making the Fed's job, I think, much tougher and much different. So I know you were one of the very first to be on that topic, so I want to make sure you had time to talk about that today.
Oh, thank you. Yeah, so I wrote a piece last year about this, and it was the title was "Interest Rates Can Be Stimulative?" with a question mark. And I'll kind of give a synopsis of the theory. And first of all, it's not my theory. It's Warren Mosler actually came up with it. And Warren Mosler is a hedge fund manager that's kind of the godfather of MMT. And the argument goes like this, that if you have a situation where, well, actually, before I explain to it, why don't we back up and just review the two ways you can make money. The one way you can make money is for the private sector to take out a loan. You go to the bank, you buy a house, you buy a car, the bank lends you money against that. That is creating money out of thin air. That is the traditional way that we did it. And that is how we have generally influenced the economy over the last 40, 50 years. So that's one way. The other way is for the government to just spend it into existence. And that is, in essence, fiscal stimulus. And everyone thinks about fiscal stimulus as actually being the government spending it. It can also mean the government taxing less. And I always say that the most MMT president in the world, in the history, was Donald Trump. And the reason I said that was because when people asked him, if the economy is doing so well, why are you cutting rates? And he always said, because inflation's low. And that is, in essence, the theory of MMT, is that you can spend up until you get to a point where you hit inflation, meaning that the government is never never financially constrained, but they're always real resource constrained. Okay. So now let's go back and think about the Federal Reserve raising rates. You had a couple of charts in there where you showed that the government actually, the consumer had termed out their debt, and the corporate side have also termed out their debt. So traditionally, when the Federal Reserve raises rates, you have a situation where it affects behavior. That's in essence why they're doing it. They're trying to change your behavior. So they're trying to get it so that you don't go out and take out that car loan. You don't go out and buy a new house. They're trying to, at the margin, make it more expensive and slow down the economy. Okay. Now, you highlighted the fact that already the Federal Reserve was one hand tied behind their back, because the reality was a lot of people were termed out. So in that they had already locked in their rates at record low rates. So they weren't as sensitive to rate changes. It didn't affect it. So the Federal Reserve was always going to have to raise rates higher because of that anyways. But let's go to the second part of this equation, the part where I say the government can spend money into existence, meaning that if they go do a deficit, they do deficit spending or cut taxes. Everyone thinks that the government's deficit, the money's just gone. It's not gone. It's actually the government's deficit is the private sector's credit. And I think that's the part that a lot of folks miss, is that even though you might think it's wasteful, even though you might think it's dumb, even though every bone in your body hates it, the reality is that if you go and you spend more, if the government spends more, the private sector is wealthier. Okay. Now, whether in the long run it works, doesn't matter. Over the short run, it works. Part of the reason the U.S. economy is the strongest economy in the world is because it ran the highest deficit to GDP in the entire world post-COVID. You guys did 20, and I say you guys because I'm a Canadian, you guys did 24% deficit to GDP. The next highest was Australia at 18. We were at 16. So we have a situation here with the U.S. that you did the highest deficit to GDP spending. You also had an economy that had termed out their debt the most, because you have this awesome 30-year fixed mortgage that's just unbelievably great. Most countries don't have that. So you have a situation where your consumers is in the greatest shape out of anyone in the whole world. It is no surprise to me that your economy is flying. Everything is terrific. Now, going back to our thing about can interest rate hikes be stimulative? The other day, I was quoted in a Bloomberg article, and the trouble about getting quoted in an article, you sit down, you talk to the reporter, you say a whole bunch of things, and then they choose what they want to write. So you're like, and then you read it, and you're like, well, yeah, okay, like I did say that, but you're not emphasizing the right part. So I first want to emphasize the idea that I am not suggesting that raising rates doesn't change the private sector's willingness to create credit. I am not saying that at all. I fully I believe that when the Federal Reserve raises rates, it makes you less likely to go buy a new car. It makes you less likely to buy a house. But for all the reasons we just said, the government, the private sector was less sensitive to that in the past. All right. But here's the other part of it. So the Federal Reserve raises rates. And what happens is all of a sudden the government, the deficit part of the government, they actually have to pay more for their existing debt. So now instead of funding the debt at, like, let's just say, I know they have a duration, but let's just imagine they funded it all at the front end of the curve. Let's just imagine that the Federal Reserve the Treasury let it float. They went from paying 25 basis points on their debt to 525 basis points on their debt. So they actually went, and their cost of owning that debt has increased. So that means that they have a higher deficit. Now, if the government had changed their spending to offset that increased interest cost, then I would never in a million years say that interest rate hikes are stimulative. But the reality is that the government doesn't change their spending at all. The government just kept everything the same. So if you keep everything the same, and then the Federal Reserve cranks rates by 500 basis points, that means now all of a sudden you have 500 basis points extra of deficit spending. And, as I say, the deficit of the government is the private sector's credit. So you never know for sure if that portion of it, that 500 bips of money that is going into people's pockets is enough to offset the decline in private sector money creation that you had because of raising rates. And it might be at first it actually is enough, and then eventually it kicks in. And to your point, David, there's lots of different people, like there's different parts of this. People that are borrowing are generally less wealthy, that they have more debt. And yet if you go look at the richer people, they're actually the ones getting the benefit of the higher interest rate. So their propensity to spend might be lower. So there are different effects of it. But the main point is that the idea that the Federal Reserve can snap their fingers and affect the economy like they have in the past is gone. And that's ultimately the problem, is that we're trying to fix a problem of too much spending, because in essence, that is why we're having this inflation, because there's too much spending or not enough taxing. I don't care which one it is. It's both. You know, and whether you tax more or spend less is a political choice. But in terms of when you're thinking about economics, their fiscal stance is too stimulative, and then the Federal Reserve is trying to offset that. They're trying to push back against that and trying to slow it down. But for all these reasons, it's not working. So when I kind of think about this, what's the outcome of this? And I go, well, I think one of the conclusions you can draw is that the Federal Reserve isn't able to affect the economy as much as we think it can. And ultimately, that is a takeaway that everyone should realize. So the Federal Reserve wasn't able to revive the economy post-GFC like we thought they were going to be able to. And now, post-COVID, they're not able to slow the economy as much as they think they're able to. And I think that, and that ultimately goes why I continually focus on the fiscal side of the equation, because I think people are underestimating the fiscal side, how important it is. And to that end, the IRA, the Inflation Reduction Act, it's like an oxymoron, because the idea that it's reducing inflation is ridiculous because it's spending more. It's really a piece of industrial policy, and it's huge, and it's continually, you know, putting a bid to inflation, and the spending is just continuing. And ultimately, I don't, there's going to be all, like, I wish I could give you a concrete, like, this is what the Fed's going to be able to do. But the reality is that the Fed is pushing and pulling against this thing and affecting the economy in different ways. And there's all sorts of different constituents that are being affected by it. So I think that part of the reason that you see the Fed being easier in terms of like being quicker to pause than in the past is because they realize that they're not really, by raising rates, slowing the economy like they think they are. And in fact, they might just be giving more money to the rich guys and hurting the little guy. And the real answer, if you want to slow this economy down, is increase taxes or cut spending.
Which isn't very likely to happen, at least for now.
Exactly. So
not
that's why
with the two candidates we have running.
Right. Which is why I think that you sell bonds, you buy inflation break-evens, you buy gold, and you protect yourself.
Well, we
Great
got
stuff. I think you're spot on.
We got one more question in the chat, and then we'll probably cut Kevin loose here. It's on EVs. How does your expectation that EVs are headed down affect your view on copper? Will there be less need for electrification than expected?
Okay. So I want to be very clear here. I think the stocks are headed down. That doesn't mean I think there's going to be less EVs made. And in fact, I think there's going to be tons of EV made because there's all this, you know, supply production, and that they're going to try to fix it by just, you know, making it up with volume and just keeping their costs lower and lower and lower and running it. So I'm actually a huge copper bull. I think that the move towards electrification is firmly entrenched. I think that we're not going back. And just because I'm bearish on the price of automakers doesn't mean I'm bearish on the amount of autos being produced. And in fact, I think we'll have record amounts of autos being produced because I think they'll be done at lower and lower prices. And I think that, to Louis Gav's point about this new BYD selling $10,000 EVs into emerging markets, that's huge. It's going to continue. And I think that owning copper is one of the great long-term trades that you should just buy it and forget about it.
We're with you there, Kevin. That was a good summary. And as he said, if you missed this, this is a point that Lee makes all the time, is that there are 91 different EV car manufacturers in China. China is now the largest exporter of cars in general in the world, from almost nothing a few years ago. It's really one of the more, I'd put it on the same level as what happened with the US fracking miracle, when we went from this big importer of oil and gas to an exporter, especially of natural gas, which is one of my favorite commodity trades at this very out of favor point, but we don't have time to go into that. So is there anybody that absolutely has to answer? We got to let Kevin go in max 5 more minutes. So
do you want to talk about China before we go?
See anybody else? Oh yeah, let's do that, because that's something you didn't get a chance to talk about, and particularly this reform. This was it the Hoku reform or Hukou, however you say it?
I don't even
Sounds
know
like
how
it's
to say
mine,
it.
but
I had no clue about this. All right, so China. One of the things that you might notice is that everyone tells you it's uninvestable. And I saw Russell Napier, who I think is one of the greatest strategists out there. I guess he'd call himself more of a market historian. He said the long-term expected value of Chinese stock market assets for foreigners is 0, meaning that ultimately he thinks that the China is going to take it away from you, and you're not going to actually be able to realize any value, and you'll never be able to get your money out. So first of all, I think that is consensus. And one of the things that I think is ironic about this is that before Russia happened, before Russia invaded Ukraine, and those stocks actually got zeroed, that the people that are the most apt to tell me today that China's uninvestable were the ones that were telling me that Russia would never have their stock market zeroed. Well, that would never happen. We're never going to do that. And now all of a sudden we've gone from they're never going to do that to China. It's going to happen in China for sure. And although I'm not going to say that you shouldn't consider that, and I would definitely always have it as a remote possibility, I think that that is more than fully baked into the price. And one of the things I thought was interesting about the Russell Napier discussion he had is he told you how he thinks the long-term value of this of Chinese equities is 0. But then he started talking about the fact that if you look at stock markets throughout the world, they generally bottom around 10 CAPE, cyclically adjusted peakies. And he goes through, he says, the great financial crisis, 10 CAPE, the Japanese or the Hong Kong stock market, 10 CAPE or whatever. And he goes through it all. And then ultimately he ends with, guess what? China is at 10 CAPE. So he talks about how this is generally a time to buy. And then he says, well, China's there. So really, from that perspective, you got to think about it. And when you look at, I have this chart in my deck that shows the EM, the amount of assets EM that has China in it,
which is emerging market, just for clarity, it's
emerging markets. And then emerging markets without China, you'll see that the ETF without China over the last couple of years has exploded in market value. So I think what I'm saying by that is that everyone is gone and has already zeroed their Chinese holdings. I mean, not zeroed, but taken them down to the point where there's nobody is left long these things. And ultimately, I believe that China will stimulate. I don't think they'll stimulate the way that we think they're going to stimulate. They're not going to go build empty villages and houses and stuff like that. They're going to stimulate in a more, in a smarter way. I also think it's not going to happen. They're not going to make a big announcement. Why are they going to go and let everyone front run them? Why would you do that? You're not in the States. You make a big announcement because your markets are an important part of the actual mechanism, the transfer mechanism. In China, they just tell people. They just say, you go out and you lend to this person, you do this. And so the government is able to do it. So I actually have spoken to one really smart, investor, a plugged in hedge fund manager. He thinks it's already happening. His argument is that's why a lot of these metals and a lot of these things have been bid over the last couple of months. He thinks it's already occurred. And to your point, David, about the Hoku reforms, I had no idea about, well, I shouldn't say I had no idea. I had no idea that there were people in Chinese society that had a social safety net. I assumed it was everyone was kind of equal and that there was no social safety net. And for those who don't know, the reality is that that's why Chinese citizens are big savers, is because there's no safety net. So they have to save in case somebody gets sick or for their own retirement. So there's huge amounts of savings in their society. But they do have these things, these huku, I don't know how to say it. I apologize. I'm probably butchering it. These huku systems. And its essence, it's kind of like a social safety net administered by a city or a state level, like a much smaller thing. And one of the things that you might do that might occur is you might get a reform in this huku system. And it could be that all of a sudden the government gives out this social safety net. And if you think about it from the Chinese citizen, if all of a sudden you get a situation where no longer do you have to worry about saving in case you're hurt or saving because you want to retire, if that's taking care of you, then you all of a sudden you have a lot more to spend. So my point was, hey, listen, I know people have been talking about this huku reform for a while, but this could be the kind of stimulus that occurs without much fanfare and actually ends up being a bigger deal than everyone expects. So to sum it up, I think you buy Chinese equities. I know it's scary. I think you do have to keep in the back of your mind the idea that there is a potential they get zeroed. But on the whole, when everyone else is worried about something, is that generally you can fade it. What you should be worried about is stuff that nobody's worried about, because that's the stuff that the market hasn't priced in, and the change from that to get priced in is going to be painful.
Thank you, Kevin. That was wonderful. Thanks everybody for joining us today. And we want to have you back on, Kevin. There were a lot of things that we should have talked about, just didn't have time. And so we'll, if you're willing to come back, we'd love to have you.
Anytime. It's a pleasure being with you. I enjoy chatting markets.
Thank you very much.
Thank you for all.
Bye, everybody.
Support.
Have a good day.
Take care. Bye-bye.